Hello, everyone, and welcome to the Savvy Cast. This is Jamie, and I'm so grateful that you are joining me today, whether you're joining on YouTube or on the podcast. I am grateful that you're here. I am pleased and honored to have as my guests today Elizabeth Brasher and Melanie Nichols, and they are going to enlighten all of us today about things in the financial realm. And welcome, Elizabeth and Melanie. Thank y'all for being here.
Thank you for having us.
I want to just start by telling how I know you, Melanie, and Elizabeth. I just met you today, but you're part of this fabulous team of people who help families in their financial areas of financial need. Melanie, how long ago did we find you?
Probably 3 or 4 years ago.
3 or 4 years. Okay. So Zane and I reached out to Melanie 3 or 4 years ago and brought her on board to literally take over managing all of our assets and our families. Melanie, just in a nutshell, tell what you do because it's so multifaceted. I think I'll leave something out.
Perfect. So our firm is a wealth management firm. We help families and individuals look at all their investments, plan for retirement, figure out how to educate their children. We look at budgeting and spending. And with Jamie and Zane, we've had the privilege and honor of getting to know their daughters and have helped them, whether it was before they got married, talking about financial information, or in a new job, how to select benefits. So we are a comprehensive financial planning and investment management firm.
Right. And Elizabeth, I just want you to introduce yourself as well. What part, because you all both work with Warren Averett Asset Management, but what is your role in that?
So I'm also an advisor. I work very closely with Melanie. We have different backgrounds. Melanie has a huge background in investments. It actually has the highest degree or accolade that you can possibly get in the investment realm. Whereas I practiced law for several years before coming over to the asset management. And so we offer different strengths. And when we come together as a team, we're able to better serve clients. But I am an advisor as well.
Because, yes, and that leads me to my next comment. When you're having or you're engaging someone to help you with your assets and with your financial planning, you always need someone with legal expertise, correct? Because there's so many legal angles to that.
I think so. Now, I practiced law for a bit. I am an attorney, but you will hear me say you need to ask your attorney about that.
Oh, okay. Well, but you all work in tandem and you are a team. And I'm so glad that y'all are here to educate us on something that's very important. And I'm glad that we're starting this now at the beginning of a new year. But what we're going to discuss today are 10 financial things that everyone should do starting off the year. So y'all, let's dive in because this is important. And especially women, I think sometimes many of us delegate all of the financial dealings to our spouses. Until I started engaging in all of the conversations with you all, I was oblivious to what was going on. And just now I feel so much more educated. So that's one reason I wanted you all to join and speak to my audience and just share some important things. So Melanie, why don't we get started? Just first, can you start by telling us how to get financially organized?
Absolutely. And as you mentioned, first of the year, getting ready for tax season is a great time to do that. Often we think about trying to get organized, and this feels like a huge mountain to climb. And I want you to know there's some really basic and little steps that you can do to sort of start tackling this project. It is not as bad as tackling kitchen cabinets and closets. It's much easier than that. So as you get ready and you're thinking about tax season, and we've sort of closed out last year, start tracking down investment statements. You or your spouse may have retirement plans at work. You may have some IRAs that are individual retirement accounts from working, previous jobs. You have checking accounts and savings accounts. start finding those statements. Every institution sends you one at the end of the year, if not more often. And as you gather those in a folder, start taking a look. And I think the easiest thing for me is take a legal pad and start writing down, okay, here's some of the investments that we have. I have a retirement account. My spouse has a retirement account. We have a savings account for education for kids, and just write those numbers down. So you're writing those down on one side of the page or putting them in a spreadsheet if you're more of a spreadsheet person. And then on the next column, what do you owe and who do you owe? Do you owe on a mortgage? Do some of your younger people have student loans? Do you have a car loan or a car lease? Do you have credit card debt? So you want to just sort of figure out where you are today, because that's going to help drive where you want to go in the future. So we need to know what our assets are and what our debts are as we get ready to tackle some of these other topics.
Melanie, for those who might be like I am, a little uneducated about all the financial terms, can you just define asset?
Yes. So asset is anything that you own that has value. Now we can count, you have on a beautiful necklace, Jamie. That is an asset, but that's not one you're going to go around and sell if you needed to, go to the grocery store, right? So assets in what I'm talking about today are cash and mutual funds and stocks and bonds and investments. Those are what we call liquid assets. Now, so it's a good question, because your home is also an asset. So write down the value of your home, write down the values of your cars, because if there's a debt on the other side, you want to have both those pieces. So if your home is worth $300,000 and you owe $200,000 in a mortgage, when you subtract that, your asset is the equity, or your ownership value is $100,000, right? So we have what we own minus what we owe, and that gives us what our net worth is.
Okay. So what we own versus what we owe equals net worth. Now, is liability the same as debt?
Yeah. So anything that we are going to owe in the future is a liability. So that's a great question. So assets minus liabilities equals net worth.
Okay. Well, this is good. Good basic things that we all need to know. Okay. Well, Elizabeth, let me segue to you. Once you know what assets and income you have, how do you decide what's most important? Because that's a lot.
It is a lot. And what we really advise people to do is sit down if you're single, by yourself, or if you have a partner with your partner, and really come up with what's important to the two of you or yourself. And you really have to dig deep and figure out, what are my wants versus my needs, and what kind of goals can I set? Because the goals are super crucial, and that's going to govern the rest of your financial picture, because you are trying to reach a goal. It's really difficult. Like if I want to save money, that's a general goal. But if that goal is not SMART, and by SMART, we mean it's an acronym for specific, measurable, achievable, realistic, and timely, you're not going to get there. So for example, if we're trying to be specific, well, saving money is not specific. So instead, we should say something like, hey, I want to save money, but I'm going to save $100 a month. That's very specific, and that's measurable, which takes us to our next part of the acronym. It has to be measurable. We can't just say, I want to save money for retirement, because we don't know how to measure our success. It has to be achievable as well. So for example, if you want to save $100,000 a year, but you only make $25,000, that's not achievable, which doesn't really help you. So, and then the goal has to be relevant, and make sure it's your goal, not your sister's, not your mom's. Because a lot of times, especially for myself, I know as a female, I'm always hearing what my other friends are doing and trying to figure out if it makes sense for me, but it doesn't always. And so make sure the goal is relevant for you, and then put a time frame on it that you can think about it and you can measure success. For example, like 6 months. Like, okay, so if I want to save $100 a month, then I'm going to review this again in 6 months to see how I'm doing, what are my pitfalls, and how to make sure I'm doing everything to ensure I'm meeting those goals. And then I want to look at, so for these goals that I'm setting, we separate them out into short-term, medium-term, and then long-term goals. So the short-term goal, we're using that SMART acronym: specific, measurable, achievable, relevant, and timely. We're going to separate out between wants and needs. And when we're talking short term, we're talking maybe, let's say a year, maybe up to 5 years. And so that want may be, well, I want to save for a vacation, but my need may really be paying off credit card debt. So in that situation, my need being to pay off that credit card debt, I probably need to be saving for that first, pay off the credit card debt before I go into my short-term want. For medium term, we're talking more 5 to 10 years. And those goals, and I think everyone in this, let's call this financial meeting, strategy meeting that we're going to have either by ourselves or with a partner. I think short-term, medium goals and long-term goals are all very important. I know a lot of people will do a vision board, like for example, with the medium-term goals. If let's say the want is to invest in a 529 plan to pay for education expenses for your children or grandchildren. And while that may seem like a need, because I know like for myself, I really want to pay for my children's education, you cannot finance your retirement. So we tell our clients all the time, you cannot get a loan to pay for your retirement. Your retirement is first and foremost the most important to fund. Your children, worst case scenario, can get a student loan. I had plenty of student loans, so I understand what that means for people. But your need may be that you need in a medium term, let's say 5 to 10 years, to pay off your car or maybe your mortgage, because it's going to be more important for you possibly during retirement to not have a mortgage or not have a car payment than it would be to make sure your child comes out of school debt free, because they have a much longer trajectory in terms of paying off that debt than you would in retirement. And then our long-term wants versus need, that example there may be, well, I would really like to buy a vacation home, but I really need to fund my retirement. And to figure out what you need for your retirement and funding that would be first and foremost, most important. And then anything else would be excess for that long-term goal.
This is so rich and so practical. And I just want to ask, because I know our relationship, Melanie, with you have helped us sort through things I never thought about. But then again, I've never done a budget. I've just, lived life. And do you find that many of your clients come in and maybe one or both have never mapped these things out? And that part of what you're doing is just what Elizabeth described, outlining all of the different goals. And you're also having to help them navigate between wants and needs, which I'm sure many people consider needs that are actually wants. Is that correct?
That's right. And so that sort of leads into the next topic. So you get these goals, and then how do you get on the same page with your partner? All right. So it's easy as a single person to say, here are my goals. Here's how I'm going to get there, because you're dealing with one personality. Right. Mm-hmm. When you put two personalities in the room, Jamie, we have discovered, and I think you can attest to this, that men and women, this, think often very differently about money, about what's important. Many of us as women are mama tendencies if we have children, or we want to do, all the things for the kids first. And we may have a spouse who wants to, save and invest and maybe retire early. So I think a big topic for you as you guys sit down and, again, if you have a partner, you're having these discussions, is what are your goals? So if Elizabeth and her husband Dale sat in different rooms and wrote down, here's what I want, here's what I need, short-term, medium-term, long-term, you bring those two lists together and then you navigate how to achieve them together. It takes compromise. Sometimes it takes a professional advisor to step in and help you navigate that. But that's a big step. So you get your goals sorted out. And then the next topic is to figure out how much money we have coming in. For many people, it is a regular paycheck. So you can look at the beginning of the year and here's how much money I'm going to get every month. Jamie, I would expect that several of your listeners or followers are entrepreneurial, or their spouses are. So maybe income fluctuates. So maybe they know here's a certain amount, but maybe there's a bonus at the end of the year, or maybe it gets very stressful every year about April because we're getting ready to pay taxes and maybe we've not saved enough for that. So I think a crucial thing is to look at your spending, and we're going to think about this in 3 categories. I'm going to start with the one that is most impactful to me, and that is, how much am I going to give away? All right. And it doesn't matter if you make $100,000 a year, $1 million a year, or $50,000 a year. It is my belief that if we take a look and say, how much do we want to give back to our communities, to our churches, to our charities. That's meaningful. And again, many times spouses are not on the same page, but take a look at how much you want to give. If you do that first, then you take a look at how much do I need to save. So again, I've identified I want to pay for kids' education. What do I need to put in every month? Or I want to save for my retirement. What do I need to do every month? And then what's left, you figure out how to live on. And the reason it's important to do it in that order is if you say, here's how much I want to live on, not what I need to live on, but here's how much I want to live on, it's very easy to let the savings piece and the giving piece fall by the wayside. So if giving is important to you, then I would encourage you to do that first and automatically. So if you make a regular contribution to a charity or a church, do that first. Do that automatically on the first of the month. And then look at, okay, then my savings needs to happen automatically. Again, if I get to the end of the month and I'm like, oh, I've got $7 left, well, that doesn't really help me achieve a goal of saving for education or saving for retirement. So giving, saving, and then living, I think that really helps people sort of identify what's important. The other thing is if you don't know what's important, take a look at what you did last year. I think there's a lot to be said for what we value, we support. And so if you go back and look at your 2021 spending, and you can do that in a number of ways. You can do it by pulling your credit card statements, looking at your checking accounts, depending on how you and your family navigate on a monthly basis. And many of us might say, okay, my church is absolutely the most important charity that I support. Does my giving reflect that? Or did I give very, very little? So again, getting your heart and your head on the same page is very important.
And Melanie, I love that. And one of the most important things that you've helped us do is get everything in one place. Because hearing you all talk, someone maybe who hasn't engaged a wealth asset manager might think, oh my goodness, there are things everywhere. There are documents everywhere. This is so overwhelming. Part of what you have done that's given me such peace is everything can be seen and as one big picture, and we see it all, and you handle it all, and you help us make decisions. For people for whom giving is a big deal, which it is a very big deal for us, can you explain just quickly how you simplify that? Explain that.
Okay. So, Elizabeth and I had this conversation the other day that it is often easier to pick one or two or three charities that you want to seriously support than 18 or 25 that you want to give little bitty dollars. So I think that would be the first thing is look at who you supported from a charitable standpoint last year. Maybe it's your church or the Salvation Army or United Way or the Red Cross. You and your partner decide, okay, these are the top 2, 3, or 4 that we are really going to support. And then come up with an annual budget for what you want to give. For many people, tithing is an important discipline. It's an important way of giving back. And so if your paycheck, you get $10,000 in your account between you and your spouse every month, and you want that first $1,000 to go to your various charities, then just set that up to make it happen automatically. I think one thing we've all learned during the pandemic is organizations have figured out that you can collect money without people having to physically write checks and be sitting in church, as an example. So however it works for you. Now, I know that many people, that the physical act of putting something in a worship plate as it passes, that's also important. But it doesn't mean you can't write your check the first of the month and have it ready to go. There is another charitable technique, Jamie, for folks who have a great amount of wealth called a donor advised fund, which is a way to donate large amounts of cash or appreciated stocks to an account. You give it all at one time. So let's say that you and Zane a stock that just was fantastic, and you made a bunch of money on it, and you want to say, hey, I might want to put $100,000, give it to charity over time. Well, it might be a good idea to donate that today to what's called a donor advised fund, and then you get to give that money over time. Probably a little more complicated than most people want to hear, but it's a great way to then keep up with all your giving is out of that one fund. So we could certainly dive into that if we ever do a podcast on just charitable giving and strategies. We could talk about that more, but we'll link some information in the show notes for you if that happens to be of interest to any of your listeners.
Wonderful. That is yes, we do need to maybe address that in a podcast because that's very intriguing. So Elizabeth, circling back, how can we protect our assets and achieve our goals at the same time?
Well, one of those ways is by using insurance. Like insurance is a great tool. When we're talking about insurance, I mean home, auto, personal liability, umbrella insurance, life insurance, and everyone has different needs. So a lot of times when we're looking at as advisors, and I feel like sometimes you really need a third party to truly look at your insurance and help you figure out if you're making the right choice or have the correct coverage, because again, everyone is different.
Yes.
There are a lot of brokers out there who do great jobs. And again, Melanie and I can help recommend those people. We do not sell insurance. We do not want to sell insurance, but we do review it for our clients and help make sure it works. But there are a lot of brokers who can look at your situation and make sure, they can kind of shop you out. So you're not just stuck with one company that does that. But when we're looking at home insurance, you're looking to make sure it's covering your home, anything that could happen at the home. With your auto insurance, same thing. And depending on your profession, if you have some attorneys, for example, I'm going to say plaintiff attorneys, they may have more liability in their personal name than other professions. Mm-hmm. So as a school teacher, you may not have as much potential personal liability as someone who's in a bigger spotlight, if that makes sense. And so you really got to consider that with looking at your home and auto. And then depending on your asset level, whether or not you want a personal liability umbrella. And for the most part, people do. And what that is an umbrella policy. If you think about a true umbrella that you take outside in the rain, it covers you from things that come at you, right? So typically you have to have high levels of coverage on your home and auto, and then you pay extra for liability coverage. And liability umbrella coverage is typically pretty cheap for the amount of coverage that you get. And what it does is if something happens, you get in a bad car accident or someone falls at your house or that kind of thing, and they sue you for more than what your insurance limits allow with your home or auto policy, this umbrella policy would kick in and help provide coverage so that people are not coming after your private assets. And I had a client one time, she had convinced her husband they needed this umbrella policy. And he thought it was a little crazy, but they had teenage kids. And anyway, she just thought it was a good thing to do. And a friend had told her about it. So they went ahead and did it. And their son got in a really bad accident that was his fault. And as a result, they got sued for about $4 million. Well, they ended up settling, but the umbrella policy kicked in. And because of that, they only came out of pocket $100,000. That was hugely impactful because otherwise it would have been, and $100,000 is a lot of money, but a couple $1 million is a catastrophic event for most folks. It would
so they would have been financially devastated had they not had that umbrella. Mm-hmm.
Yes. And it's cheap coverage for the most part. So it's just, looking at your risk and seeing what makes sense, especially to protect your assets. And then also life insurance. And life insurance is different for different people. A lot of times for young people or young families, we're looking at income replacement in case something happens when their children are young and looking at what their goals are. Like in my house, we would like to get both of our children through college if possible. Something happened to one of us. And so we have term insurance that pays for income replacement. So if something happened to me or my husband, then the insurance would kick in and be able to help provide support during that time. So those are all really good ways to hedge against risk and help protect some of our assets.
Well, and just on that note, on a very practical level, I did not think Zane needed life insurance on me because he was the primary breadwinner. But I then realized, Melanie, I'm sure you were the one who pointed it out. If I had died, when our children were at home, he would immediately have to find someone to at least fulfill the roles, raising children, whether it's a nanny or a housekeeper or whatever. So that there is a need to, I guess, have life insurance for both parties, correct?
Absolutely. And when you're talking about that situation and people who have young children, typically you have different types of life insurance, but term life insurance means you're paying a premium, paying a payment for a policy that has a rather large, I'm going to call it large value, like we'll say $1 million, for example. And you're not paying very much per month because if you don't use it, you lose it. But it's cheap coverage to ensure if something catastrophic does happen, you'll be okay. So in that respect, if something had happened to you and you had this coverage, you're not out of pocket that much, but yes, you still can have great coverage because it is expensive. I mean, a full-time nanny, if you have small children at home, can be $45,000 a year. You know, when you really do the math.
And you all do, if someone comes to you and they maybe have whole life or they have some things that aren't what's best, you all can help. And Melanie, you did this with us. We had different people from where we had lived that were, you know, that we'd contracted with, but you helped us consolidate, get the right insurance in every area. That's part of what you help people with is, because especially if you've been together for decades and you've lived in several areas and you got your life insurance here, or you got whatever, it can be a little bit of a quagmire.
Right. And as Elizabeth mentioned, things change. So they needed some term life insurance on you when your girls were younger, but he doesn't right now. So life changes. And that's the other reason so many people buy life insurance or buy car insurance or start an investment plan and they never think about it again. So they're excited because they've sort of checked that one off the list. But those are financial decisions that need to be looked at on a pretty regular basis.
That's good. Elizabeth, can you discuss the pros and cons of debit and credit cards? I mean, because I think that's just a very practical thing that needs to be spoken to.
Yeah, absolutely. And again, every situation is different for every person. And this is something that a good financial advisor can help you walk through what's best for your situation. But credit cards used to, got a bad rap. And as much as I love Dave Ramsey, I disagree with him. I think everyone needs credit in this world, and credit cards are not bad. So when we're talking about credit versus debit, it can somewhat be a personal preference. But for my clients, I recommend everyone, unless they do not have the discipline to pay it off, to use a credit card, even for everyday expenses, and pay it off monthly. Because if something happens and somebody gets your credit card, like here's an example. My husband got an email that he was signed up for some Walmart. It's like an Amazon Prime, but some sort of Walmart account that he did not sign up for. So we went and looked, and sure enough, someone had ordered some things out of somewhere in California. We did the Google map and found out where we figured it all out. But he was able to go on the credit card and contest it. When he contested it, the credit card company refunded our money immediately. They sent us a new credit card and they fought it. If we had had a debit card and that had happened, one, our debit card's floating all over the internet. It's attached to our bank account. Someone would have had access to every bit of money that we had in our bank account. Two, if something like that had happened, the bank will make it right typically, but it takes forever, or it seems like that when you're waiting on the money. If it's a big sum of money, you could be waiting a long time and then you're without the money until they make it right. For me, I feel really comfortable with a credit card because we pay it off. You can also get points. So you can kind of play the game. Like if you like to travel, you can get a lot of points so you can fly either specific airlines or general travel. We use a Chase Freedom card at my house. It's a free card and we get, 5% cash back on certain things every quarter, and it works for us. If you go to, there's sites like NerdWallet, for example. And if you go on NerdWallet, you can go and look at different credit cards and see, okay, well, these are my needs. Like my husband and I have 2 small kids. We don't travel anywhere. So we're not travel point people now, right? I have hope our medium-term goal is that we will get there. But we're not travel point people. We're just general cash back people. But you can go on NerdWallet and see what suits your needs best and see what fits you best. I also feel like credit is very, very, very important. So as women, a lot of times, as you're talking about, Jamie, maybe you were not the financial savvy member of the relationship.
Mm-hmm.
And especially for women who stay home, I think this is really important to realize you still need credit.
Yes.
So just because your husband has opened a credit card, it does not necessarily mean if you're on it, you could have a credit card in your name, but you may not be on the account. So what I mean by that is if you open a credit card and you get a card for your child and it's in their name, or if your husband opens one and your name's on it, it doesn't necessarily mean that it's helping your credit. It may just mean you're attached to their account. So as you're talking this through, make sure you understand, is this credit card hitting my credit report? And if not, it probably makes sense for you to get a credit card that hits your credit report so that you can make the payments and earn and gain good credit.
Okay. May I ask a question that I'm sure a lot of women are thinking?
Sure.
And I totally agree with you. I very rarely use my debit card. I only use my debit card to go to the bank and get cash to pay like my dog walker or, tips.
Yeah.
Everything else, we pay our credit cards off every month. Even the simple inconvenience of if you purchase something on your debit card and the next day or two think, oh, I really don't want this, and you take it to return it, it's much more complicated. They wait because it's cash. It's like you're dealing with cash and you're not getting and yes, the credit card companies take care of you. We've had many incidents where there was fraud and they take complete care of it and they refund you immediately. So that is very true. But this is my question to you all. Every time I've opened, and I don't think Zane tells me don't open anymore, and I don't have a ton, but I will put my name, my social security, all of that. But then when it gets to income, I put his income because we're married and his income is mine. Elizabeth, is that going toward building my credit up or okay, because the credit card company allows that. If you're not the breadwinner, you can still build up your credit with your spouse's or your partner's income.
Yes, 100%.
Jamie, one thing that's important, you and I've had the conversation. We've had friends or mutual acquaintances who are contemplating divorce.
Yeah.
And one thing that you will always want to make sure is if that is something that unfortunately is in your future, imagine what would happen if you no longer have access to credit cards that were only opened in your spouse's name. So one way to make sure, Jamie, that the accounts are on your credit report is to go to one of the 3 credit bureaus and get your free report. Every agency has to give us a free report every year. So it's Experian, TransUnion, and Equifax, and it will list all the credit cards that Jamie's ever opened and that are in your name. So I think that's one way to, if somebody's in a situation and they're not sure if it's in their name or they just are on the account, to run a credit report will show you that.
Okay. And I appreciate that. And I appreciate that you have said all people need to build up their credit, especially women. And I know, Melanie, you just worked with Mary Judson and she just got her first credit card. She's single and working. And trust me, she's not like her mother. She won't be charging a lot. She'll be paying it off. But you're helping her build her credit as a young, independent woman. I do want to ask this before we move on, I do want to make a point. When I was at Auburn, I had one little credit card under my parents' name, but I had bought a tube of lipstick. Now, I was at Auburn, a college student, and they kept sending the bill, but I thought that I had paid it, so I kept throwing the bill away. Well, it was like a $10 tube of lipstick back then. And when I married Zane, that was on I don't know, I guess it was in my name. And, he's Mr. Perfect Credit. And I still to this day hear about that tube of lipstick because as us being married, I guess it affected him. He acted as if it was the worst thing possible. So can you maybe speak to that? How let's say you're going to get married and maybe you forgot to pay off a tube of lipstick or there's something not great in yours. How do you reconcile that and get things right really quickly? And does it necessarily affect who you're marrying?
Well, So what I'm guessing what happened is you didn't pay it. So for the tube of lipstick. And so then you got charged, 20% interest, and then you got some penalties. And the next thing you know, that's a in default $100 bill. And it's against your credit because you let it go. When you look at your credit report, it'll show you what liabilities or what you owe in the next 30 days, 60 days. And I think where people, and especially younger people, is that delayed gratification seems to be a concept that is not a term every day. So you'll see, if you want it, just go buy it. Well, the problem is if you can't afford it and you can't pay it every month, you really need to take a hard look at what those charges. And I think the credit card companies, the way they make money is for us not to pay our credit cards off every month, just to pay the minimum. And the minimum is so low that you literally could be paying for the tube of lipstick or the dress or the pair of shoes for the next 10 years by the time you pay all the interest. So some people thinking about getting married or combining finances, I encourage people to get their financial house in order and make sure that stuff's cleaned up.
And would you both say, if you are not willing or able to pay your credit card off every month, don't get one?
Yes.
Because that's where you get into trouble. And I will say, I don't think we have ever not paid it off in full, which the credit card companies don't like. They want you, Melanie, what you've said, they want you to say, oh, but you're being charged interest.
Right. The only time that, and I'm, Jamie, you and I are similar in we love to shop. And so it is easy to be in Macy's and you've got a big pile of clothes and they'll say, you can save 20% if you open this credit card today. That is very, I used to do that all the time and it was driving my husband crazy. I still paid it off. I wanted the discount, but all those things are also now on your credit report, frankly, forever. So the only time you need a new refrigerator, as an example. Hopefully, when you go to buy the new refrigerator, if you can't pay for it right away, obviously a credit card is an option. I would say that's a need versus a want. Your refrigerator's not working. But most places like Lowe's will let you pay for it over 12 months at a 0% financing. So use companies when you're looking at big purchases, whether it's a car with a low interest rate or it's a major purchase. A lot of companies will help you do that versus paying for a refrigerator on a credit card that you're going to get 25% interest, right? So look for opportunities to spread payments out on big purchases with a 0% interest option.
Okay, I love that. And I do want to interject, to me, and maybe people listening have not thought of this, but to me, one of the best ways to do that, one of the best companies is Best Buy, especially if you're young, married. You can get all of your appliances there, and you can get, your any Apple product, your iPhone, your Mac, things that are needs for business or home. And they have 12 months, 18 months. So Zane has said it like this: if they're letting you use their money for free, use it. So do you agree with that? Okay. Rather than, to me, that card it's less sexy than my Athleta card because I love Athleta, but I do have an Athleta card because I get quote unquote free clothes, which Zane laughs. He says, no, you bought those clothes, those points, you paid for those points. But I think looking at, if you're just going to get one or two credit cards to have interest free, something like Best Buy, you can hit more purchases and spread them out more than a niche like clothing or Saks or.
And the one thing about that, though, is make sure if you get a 0% interest credit card that you're taking the total value that you financed and you divide it over the course of the 0% time frame. Because what they'll do is if you do not, you'll still be paying a minimum payment that will not equal the value of the purchase. So, for example, the refrigerator, let's say you spend $5,000 on the refrigerator and they give you 12 months interest free. Well, they may actually, the minimum payment may be $65. That's obviously not going to equal out to $5,000. And then at the end of that period, it's going to balloon to a 24% rate. So what you need to make sure you're doing is do the math and then every month pay whatever 5,000 divided by 12 is to make sure, or like for me, I like to do 1 month early. So 5,000 divided by 11 and make sure you pay that off.
That is great. Yes, that's wonderful. Melanie, one of the big topics that I think interest women who start getting financially savvy is investments. And my daughters, even my young daughters, they're like, "Oh, where should we invest our money?" And, that's a small scale investment, but can you just quickly address that?
Right.
Investments.
And again, you could do a whole podcast on this, but very basically, when we have money that we are saving for a goal, we have three options. We can put our money in cash, which we all know is earning nothing right now, but it doesn't lose money in the short run. We can put our money in bonds, or another word for bonds are fixed income. And those are investments that typically pay a fixed rate of return, or a coupon, if you will, interest rate over a period of time, and are usually very safe. And we could buy stocks, or another word for stocks are equities. And equities or stocks are assets that we want to buy for longer term goals like retirement. So the very first thing when you're thinking about investments is it's very difficult to pick the very best next stock, or the safest bond. It's much better to think about how to diversify or spread your assets over different types. Like maybe you want some in U.S. investments, and maybe you want some in international, or you want some in large companies or some in small companies. So that's called diversification. And again, most people either need to find an online solution to help them with that. One I can recommend is called Schwab Intelligent Portfolios. And in that, Jamie, you go online and you tell them, okay, this is the goal, or here's how long a time frame I have. Help me pick investments that will help me achieve that goal. But working with an advisor is a great way to also get a diversified portfolio that suits your specific needs. So, for example, if I had met you and Zane 15 years ago, one of our big things would say, okay, as 40-year-olds, what do you need to do for saving for your kids' retirement in a way that we are pretty sure we're not betting on one stock, but in a diversified manner that helps you all educate your girls. At the same time, we would have said, okay, y'all are 40 years old. Where do you want to be at retirement? What assets do you want to have? And we would look at investing those assets in a different manner. So it's called asset allocation or risk tolerance. You want to make sure that the risk you're willing to take and able to take lines up with your goals. So again, there are some online solutions. And then again, hiring a professional advisor to help you navigate that probably is the best way for most folks.
Okay, that's very good. Okay, y'all, I apologize to my audience. We are on now number 7. I have not been delineating these, but we're hitting 10 things. So in the show notes, they will be perfectly outlined to match the content. So, okay, let's go to number 7 actually, and that's beneficiary designations, which would be like IRA and life insurance. So that's number 7 of 10 things that are important.
Okay, so when we're talking about beneficiary designations, we're talking about assets that, like an IRA, like your 401k, your IRA, your individual retirement account, life insurance. Sometimes we'll have bank accounts that transfer on death. And these are things that transfer outside of probate. So what that means, if something happens to you and you pass away, then those assets do not have to be probated, which is a process in which your executor would go to the court, open an estate is what it's called, and they put your will in, and it takes 6 months to 4 or 5 years, depending on how long, just what all's involved. And the assets technically cannot really be distributed or touched in full until that probate is finished. So instead, an investment account, a 401k, life insurance, and then sometimes people will choose to have bank accounts or investments account transfer on death. They pass immediately. So those are considered non-probate assets. So when you're looking at non-probate assets, you want to make sure last year, or this is a good thing to review probably every year or every so often, or after a big event or prior to anticipation of a big event. So divorce, death, birth, marriage. So for example, if let's say I got divorced last year, I want to go ahead and make sure all of my 401k, my life insurance, I want my ex-husband removed from everything. He doesn't need to benefit from my death since he apparently wasn't good for my life, right?
Mhm.
So those are the kind of things we really need to make sure we're taking care of. That's just vitally important. If you have a new baby, do you want that child to benefit? For example, I have 2 children now. I need to make sure that my beneficiary designations encompass my daughter, because if my son is the only one who's listed, my daughter won't benefit. So those are the kind of things that we want to keep looking at and making sure that it still suits our needs. And the same thing, and going to our next point, the 8th thing that I think we should be doing every year is reviewing our estate plan and making sure that still fits your needs. If you do not walk away from this podcast with anything else, you need an estate plan. You need a will. If you are married in the state of Alabama with no children and something happens to you and you pass away, your spouse gets half of your stuff and your parents get half of your stuff. That was terrifying for me when I first got married. And so my husband and I got wills done like the week we got married, because I did not want him and my mother to be fighting it out if something happened to me, because grief does funny things to people. You just got to be careful. If you do not have a will and you have children, it gets more complicated. Your spouse would get a portion, your kids get a portion, but the court would appoint a court appointed person to hold that money for those kids. It gets very complicated. A will just bypasses all of that. So when you're looking at an estate plan, you want to make sure that you know what you have. That's called your bounty. Like, you want to understand your assets, figure out where you want them to go. I don't want to say pretty simple, but it is with a will. And then you want to make sure, if you have young children, that you designated a guardian. And a lot of times that designation paralyzes people from acting, and they get so caught up on, I've got to have the perfect person, they don't do anything. If there is no one, you run the risk of your child possibly getting put into the system. You run the risk of someone getting your child that you don't want to have them. There's a lot of risks here. So it doesn't have to be the perfect person. Like, I have a 4-year-old and a 1-year-old. We've changed the guardian 3 times. It's a simple change. Life changes, because the first person we named was fabulous and then had a health issue that they just can't do it anymore. Anyway, it doesn't really matter. But these are things you want to make sure you're updating, but do not let that paralyze you from acting. And then make sure you have a power of attorney, and that helps manage your business affairs, pay your bills if you become incapacitated. So we're talking a car accident where you were unable to act for yourself, or, more recently, COVID, right? What if you've gotten so sick with COVID or an illness that you can't pay your power bill? Someone else needs to have the ability to do that. And so you want to make sure that power of attorney is still someone you trust, especially for our single friends. This is very important. So again, these are good things to review yearly and make sure they still apply to your life.
So if you are not married, you still need power of attorney, but it just needs to be someone you trust to act as you would wish them to act on your behalf, and have that conversation with them.
Yeah, I think that's wise. Yes, and it has to be a person. So a lot of times we talk about having a court, like sometimes people have a corporate trustee. They have someone who will step in and act on their behalf if they pass away, or a corporate executor. But you have got to have a physical person be your power of attorney, and also your healthcare power of attorney. So your power of attorney does business decisions. Your healthcare power of attorney makes decisions if you're in the hospital and need medical care. So, and those need to be reviewed periodically.
Okay. Before we move to number 9, so let me make sure I'm clear on this. If your children, now we're talking about in Alabama, and does this apply? Does it differ per state as far as the age? But if you have children under the age of 18?
19.
Okay, 19.
In Alabama.
In Alabama, you don't have a will, they can literally be appointed to someone you would maybe, they can arbitrarily just appoint them where they want to, the court.
The court determines who would take your children, yes. And the practical application is typically a family member would probably say, hey, I'll do this. And the court, you hope, would go with that. But this could be, but when you think about that, like, my parents live in North Carolina. My parents are not a good fit for my children. They're in their late 60s. My kids are not used to being with them all day, every day. It might make better sense in my situation for my best friend to take my kids who knows them and that kind of thing. And so, but the court will typically tends to defer to family and that type of thing. And so it's not even a bad choice, right? Because my parents would care for my kids. They would make sure they were fed and all that. But when you really, you know, your kids, what's the best case for your kids, you really need to make those choices so the court doesn't.
Oh, that's great. That is so helpful. Well, okay, y'all. Now let's move to number 9, monitor monthly and quarterly.
Great. So I will take these and I'll combine 9 and 10 because I know we've run a bit. Number 9 is monitoring your spending and looking at your investments. And one, spending is just hard. I mean, nobody wants to feel like they're being on a budget or they're being held accountable, except that these are your goals. And so you are holding yourself accountable. So I would suggest that at least monthly, you sit down and look at what happened last month and am I on track to do what I want to do? It's the same thing as wishing we could lose 10 pounds, but being unwilling to ever monitor what we're eating, right?
Mm-hmm.
So that's a quick way to say, okay, am I on track? So monthly, take a look at your spending. You and your spouse sit down and say, okay, we expected to spend $1,000 on groceries. We spent $2,500. What's up? You know, what changes might have been. On a quarterly basis, I think it's helpful to look at your investments. Did they do well? Did we save into our investment accounts like we were expecting? And then finally, once a year, end of the year, my husband and I do this in January every year. Sort of it helps us get ready for tax season. So circling back to where we started, get all your investment accounts, your credit card statements, your loan documents, and then see where am I versus where I was last year. For me, an easy thing to do, and you can keep it on a piece of paper or in a spreadsheet. You know, my investments were worth this much at the end of 2020. How am I doing now? Did I improve my situation financially? And if not, why not? Maybe I bought another house. Maybe I bought a car that, you know, took some of my investment account. But again, look at it on a break the task up so that it's manageable. If you look at spending every month, investments every quarter, and then do a big picture look every January for the last year, I think you'll become much more financially savvy.
Well, before we end, I want to say this to anyone who follows me or is watching or listening. I personally, it's one of the greatest gifts what you all do for us, because all of this makes my head spin. It's something that is not my area of expertise. And even though Zane is financially savvy, he's all over the map, busy with other things. And I feel like this is something that finances is so dynamic. It's not a once and done. So to have you all covering our back, covering every base, reevaluating every year, bringing us to the table, reminding us, okay, we need to meet to discuss these things. It is something I think every person should consider, unless they're the most organized, financially astute people in the world, which that's probably a small amount of people. So as we end, how can people connect with you to find out how you can help them with their goals?
Perfect. Thank you so much. Well, we're going to put our information and contact in your show notes, but Elizabeth and I work for a company called WA Asset Management. Our website is waasset.com. And we've got a great team here of advisors. We've got folks of varying ages. We've got some wonderful male advisors as well. But Elizabeth and I are particularly passionate about working with women and women and their families to help you achieve your goal. So we really appreciate your time today, Jamie. Thank you for including us. And hopefully everybody found at least one nugget or two that can make an impact on their financial life.
Well, I know they did. And thank you, Melanie and Elizabeth. And I'm going to have you all back for more discussion. And thanks so much for your time. And y'all have a great day.
Thank you.